All right. Hey, good evening, everyone. Welcome to the Hurley Investments Market View Commentary for the last day of January. My name is Kevin Hurley. I'm going to start today because I'm a little bit worried about some things that I have heard from, I'm going to say some of you, but one of you, et cetera, et cetera. And what I'd like to spend my time doing today, one more time, is helping you education-wise understand terminology, returns, and our process here at Hurley Investments. And I still can't spell worth beans. That's why we have autocorrect. All right, so to start out with, we've had a pretty good rebound today. In fact, last week and the week before, I really enjoyed seeing us handedly beat on the way down. And right now, we're even slightly beating on the way up. Which for me, that's what I'm looking for. I'm looking for making up some of the downward movement and then being able to even be more profitable than the S&P today on the way up. That tells me that we're ideal at where we need to be. We're ideally exactly where we are looking to be. And I like that position to, thank you, ADP, Abraham. I like that's where we're at. So if I'm looking at where we're at right now, once again, I like that we were making more on the way down than stocks were losing. And that we are also, and I'm going to put also in capital letters, making more on the way up than stocks are gaining. Can't spell. So if you guys were to put in if you guys were to put in a sentence, what is our process here at Hurley Investments? And I particularly want Jerry, nice to have you with us today. Welcome to the group. I particularly want Bill Brandner and Amy, you're in there. Where is Rich Mormon? Rich Mormon, I'd like for his comments. But what is our process here at Hurley Investments? Someone give me some ideas. Dan, nice to see you here. We have Howard here for the first time. Boy, we got some more people finally joining us. Absolutely love it. Jerry, I was expecting you last week. Glad you're here. Welcome for those of you that are new here. Hurley Investments Monday evening. We're prepping you for what's happening in the market this week and what we're looking at doing for individual positions. So Dan, nice to have you. Howard, nice to have you. Jerry, again, I made the comment. Always good to have you guys. Good to see you here. And actually, Jerry and Howard, Mary and William both said, glad to have you guys here and welcome to the group. Dan Sweeney asked, who are you and how are you related to SOS? So the short answer, plain and simple, Jeffrey Dunyan and I years ago were working for the same education company. And I said, Jeffrey, we know what we're doing. We should go trade people's money. And Jeffrey's comment was, no, that's too much stress. Kevin, you should come with me and we should teach it to people. I said, no, I'm all into making money, right? That's what I'm looking for. And he's like, well, Jeffrey went the education route. I went the managed money route. But Jeffrey kind of put all the pieces together after spending $65,000 on numerous other educations. And hopefully I'm one of Jeff's best students. I actually turned trading in the market into a business, Dan. Okay, so what's our process here at Hurley Investments? I've seen a couple of them. I like it, right? Caller trading. And I also sound down a couple more protective puts, right? And then I got two very perfect comments that I really, really enjoy, right? Make money on the way down to have a better return on the way back up. And the second one, thank you, we dollar cost average to buy more stock with the money made on puts, which is exactly the process that we do. So, time frame. Does anyone here think I can just move the market and tell it what to do at a moment's notice? And Russ, you've known me for forever. Bill, you've known me for forever. I'm looking for a comment from Bill, definitely. Do we truly have control over the market swings? Hell no, you can't tell the market to do anything, which is correct, right? But let's look at some of the processes and where we're currently at, because a couple of you have worries, and for the most part, I think those worries are unfounded. And Bill's trying to be nice tonight. I don't want you nice tonight. So we can easily see that at some point in time, Boeing made a run from 150 up to 435. It's then fallen down to 113. And currently we're sitting today at what? 200, right? So if I was to ask you based on these numbers, and the number up here was 435, what kind of return does Boeing have in it sometime in the future? What kind of return does Boeing have in it sometime into the future? I like it. The comment there was a 100% return plus. Wow, in fact, three of you put it in there. Perfect. And two of you also said, well, it has $235 getting back up to 435. I agree with you. Now, what if on the way down, you picked up 230% more shares of stock? What does that tell you? Ooh, I gotcha. It's not 330% return. It is more than 200, Mark. But yeah, when you add that 200% up to here, and 230 plus initial 100 or 330, right? A 330% net total, more shares of stock. Means when you have 100% return on that, you're actually looking at a 660% return on your investment. That is the catch to making up money on the way down, picking up more shares, having it come over. And understand, if I'm looking at this process, our highs are right here. We're going to say April of 2019. We've got 1 year. We have 2 years. We're going to hit our 3rd year right here. It might not come until that 4th year. Kevin, how are you judging that? 1, 2, 3. It was a 4-year cycle on the way down. It could be a 4-year cycle on the way back up. Let me run to another one that we're in. And actually, that's a very good question, because yes, there are 2 of you that were kind of bitching and moaning about, oh, Boeing's going down, it's so bad. You know, for both of you, we picked up over 200% more shares of stock. So yes, some of you are converted to $200 leap bull calls, stock replacement strategy. So yeah, some of you I've got converted to a leap bull call, which will still make the $200 on the way up on about a $40 investment, which will be a 500% return, but that'll help your portfolios from not being so volatile. Going to Baidu. Oh, what a bugger, right? Yeah, I get it. So let me answer that question differently. So the question just came in, Kevin, why the hell are you in Baidu, right? In fact, Bill, I'm surprised you didn't give this one to me, but of course, William will mention it. Kevin, why the hell are you in Baidu? Well, because this is the one that over time, dollar figure wise, we've made millions and millions of dollars at. I would almost say tens of millions of dollars, but I'm probably not quite there, but I'm very close. But anytime you see a beautiful run from what, 300 down to 82 with a run back up to 354, most of our puts were at 330 on the run all the way down to 200, where we basically made it dollar for dollar. Actually, it's down to 250, not 200. It was 250. We ran into troubles from 200 down, 250 down to 200, and then we did pretty darn good, if not dollar for dollar, on the way down from there. Bill asked, didn't it lose 50% or so last year? No, it lost like 68% last year. The beauty of Baidu, losing 68% last year at the lows. Thank goodness we had protective puts on. Thank goodness we're able to make up about 60.5% of that 68% downward movement is what we are making up. Kevin, how could you be in Baidu? Well, Baidu owns 30% of Alibaba, 30% of Tencent, like 66% of IQ. It's the ultimate opportunity to be in a great second largest economy stock that has its fingers in 7 or 8 different sectors out of the 11 sectors. So Cy kind of jumped the gun. Cy Hendricks is also a new one with us. Welcome, Cy. Because Where am I going? Because someone sent me a little interesting bit on the ARK Investments and Kathy Woods, where literally she's going all in. Not only did the fund lose over half of its value, it also lost half of the money that people were investing in it. Like another 1.6 billion came out of the ARK funds. So the amount of funds that were in the ARK holdings or Kathy Woods holdings, there are 5 major funds. And Cy, if you go back in time, you'll see I hit on these the last couple of weeks. They're in trouble. They're in trouble anytime you see a 77% drop. It really, really looks bad. So what are the opportunities? If I can go ahead and get back to where we're at, what do you do if a position loses, let's say 50 to 70% of its value? And if I can throw one more in there that's not quite that bad, but another one of our core holdings is Disney. Another core holdings here at Hurley Investments is Disney. Not looking good, right? But look at the time frames on this one, just a little bit. 94 to 152 to 79 to 203 to 129. Where can it get to? Well, it can get back to 203. It can actually get back to 208 if you want to go intraday. 203 to close, right? Is Boeing, is Baidu, is Disney in any jeopardy of going out of business? Well, Kevin, Boeing did say they might be short on cash. They might have to sell some bonds. You know, they only got in a new $34 billion contract today. Disney's not short on cash. It has its movies coming back out. We'll see another couple billion-dollar movies coming out of Disney. But the question is, what do you do if a position loses 57% of its value? You guys have the opportunity. I'm going to tell you what we do, but what do you guys do? So perfect. And you know what? It's funny you would say that because someone realized that the other night and they said, hey, don't get rid of it because then we can't be in it when it bounces back. Yes, you do have the option of getting out of Dodge, right? Which equals to taking the loss. What else can you do? Okay, so that's interesting. You can dollar cost average, but that could equal putting more money to bad, right? I get it. That's why we don't do the traditional dollar cost averaging. What did Cy say here? In fact, both of you said that. That's interesting. Cy says, double down and hold. This just isn't the same as GameStop and AMC. It'll come back and get your options in place. I love it. Watch your protective puts go up in price. Perfect. Buy more with profits from protective puts, which is exactly what we do, right? At Hurley Investments, we use the profits from protective puts to add shares for a higher percent return when the stocks come back. 100% correct. And that's the name of the game. That is truly the name of the game. That is how well, I should just say this is how, if you look at the 2020 Hurley Investments YouTube returns video, you see how we made a killing. But got to understand, big drops down and recovery back to highs is the process. And again, there is no timing. Timing is a fool's game. It truly is. So with that said, taking a quick peek, I think I've got some stuff in here. Today, we took off puts on Apple. Although they're not cleared out yet, so it doesn't do me any good to show this to you. Well, actually, that's not true. We can see some of them are cleared out, but not the ones I was expecting. 0, 0. Probably have to allocate some of these. Those 5 are allocated out. We sold off puts on Apple, which I might as well go ahead. I might as well go through some core, right? We sold puts on Apple today for a slight profit and a slight loss on the other set. We sold Facebook puts for a nice profit. And rolled down to 315. So those of you will see 315 puts allocated into your accounts tomorrow. Kind of interesting. We need to sell protection off Bank of America and have plenty of profits to add 100, 200, or 300 shares to accounts as profits allow. So someone please tell me, what's the difference between those who are getting 100, 200, or 300 shares added? Dan makes a quick question. Question of protective put. How close to the money and how far out do the expire dates? So Dan, it's pretty simple. For a protective put, you typically are looking to put them on somewhere between 2 weeks to a week before earnings, and you want them to extend at least 4 weeks out past earnings. That gives you low volatility crush, meaning your position won't lose a lot of money right after the earnings, and it allows you to cover the time period where I'm pretty sure the number is 83% of the time stocks will lose 10% or more of their value the 2 weeks before earnings with a pre-earnings announcement and the 4 weeks after. So all we're trying to do is protect stock ownership around the 6 weeks of time that will happen 4 times a year around those earnings. Okay, no one answered. Well, one answered, but what's the difference between those who've had 100 shares, 200 shares, or 300 shares added to their accounts? Anyone? Anyone? Bueller? Oh, so Howard, that's correct. Number of puts, or for those of you that are kind of new, and Howard, I know you're kind of new to this, or the longer you collar / protective put shares of stock, the more shares you gain, and the more shares you have allows for a higher percentage of shares added to your account. So for an example, for those who have been Ford over a 4-year period of time, your 1,000 shares became somewhere between 3,000. I think the most we had was 3,800, right? And Ida's here. All right, I can change that. Apparently it could have went up to 4,400. And that was from adding long puts and adding shares. If I can bring up Ford for you, because I know where we got in at. A lot of people for Ford. It's actually more than 4 years. 1, 2, 3. It's supposed to be $12. Maybe it's $11.50. But just to give you a simple idea, 11 down to 8, that's probably 20% more shares of stock. So 1,000 shares becomes 1,200. From 10 down to 7, there's 30% more shares of stock. So your 1,200 shares now becomes 1,500 shares. From 9 down to 6, 20% more shares of stock. Your 15 becomes 1,800. 10 down to 8 is probably 10% more shares of stock. Your 1,800 becomes 2,000. The big one was from 9 down to 3, and we didn't make anything up till that 4.5 mark, where your 2,000 shares of stock becomes 4,000. Another drop is right here. The 4,000 becomes 4,400. It's pretty amazing, because if you're buying shares of stock around $12.80, let's just erase some of this. Just going through the numbers with you again. The initial investment, for crying out loud, Hurley. Initial investment of $12,800-ish, right? Is now equal to 44 times, and Ford is at $20.30, which is now equal to 4,400 times 2030 is now equal to 89,320. Take 12,800 And let's be honest, we probably had a little bit more put in there along the way. Let's take 14,000, divide it by 89,320. 14,000 divided by 89,320. Why is that not working for me? Divided by 14,000. So I'm doing it wrong. Got to do it right. 18,320 divided by your initial investment, 14,000, equals a 6.38 or 638% return. The problem is that happened over 1, 2, 3, 4 years and 2 months. Would you guys be okay with a 638% return over 4 years and 2 months? You want to talk about averages for those of you that don't understand averages? If you average that out, it equals 159% per year. Even though it really came, you know, to being truly profitable, somewhere in here, which is 1, 2, 3 years later. Very true, Keith. There we go. I like the answers. I would be okay with it too. It's just a matter of process. Keith is correcting me. What I really should have done is taken out, it's really though 89,320. You take out your 12,000 or your 14,000 of, take out your $14,000. So your profit is equal to 89,320 minus 14,000, which comes out to 75,320. So let's put the correct numbers in here. Figures key would tell me how I'm doing it wrong. 75,320. 75,320 divided by 14,000 comes out to 5.38, which would be a 538% return, which divided by 4 is equal to 134.5% return. There, the numbers are exactly accurate. Thank you very much. But the interesting part is it really came in the last 14 months. So let me go through a couple things just to make you aware of them as I see them. Big picture. The worst is yet to come, possibly. The NASDAQ peaked in March of 2000, and it didn't break above it again until, all I'm reading is right here, until October 2002, it was a process. And we actually had a lost decade. 13 and a half years till the NASDAQ got to break even again. Are we going to run through that again? Probably not. We're not looking at another lost decade in our stock market. But we do have a process here that we are probably going to take some losses in our indexes going into the near future. Someone asked me recently, well, Kevin, how bad can it be? If you bring the chart out a little bit more, not too bad. You can predict some of the high flyers. But they listed pretty carefully what the concerns are. Pivot to a hawkish mindset. You're going to have your fellow shareholders that are going to sell in these interim rallies, cut their exposure, cut their losses. Rising interest rate environment. Speculative fever has been broken. Other pursuits, macro things. We're still worried about Russia invading Ukraine. Will that truly affect the United States? Will it affect supply chains or so forth? It won't. But will our market still go down? Yep. Quarterly earnings reports most recently, one of the shortest beats that we've seen. One of the companies are not beating like they used to, and it's not a good sign after it comes after what's supposed to be the best quarter for earnings after that Christmas vacation, Christmas holiday when everyone goes into debt and they buy all kinds of stuff. Bill's actually reminding me, hey, if Grantham is right, we could lose 45 to 50%, and he's now gone up to like 65% drop. Maybe. But all we're going to do is our process. We're going to pick up a crap ton of shares like we did in 2008. We could double or triple up on our options on the way down like we did in 2008. If we have a 45 to 50% correction, every $250,000 could have the opportunity to turn into somewhere between $600,000 to $1 million the following year. If Grantham is right, we will all love puts. You better believe it. And what we learned in 2008 is you see put levels fall, we're just going to keep adding a second set and a third put set as we fall through support levels. On a day that we might get a bounce higher, we're going to take our most profitable puts up. In 2008, we were running as much as 3 sets of puts at a time. On Apple, we were making up about $2.10 to $2.15 on every dollar down. I only remember that one because that was our biggest investment at that time. So, are we shedding off in the last 2 days? Have we taken off all of our put protection? No. In fact, we even held on to our put protection because the markets, like the Dow, are still bearish. Yes, we're breaking. And thank goodness, because it's about time, right? We're breaking the 200-day at 34,981. But we still have the 50-day. We still don't have our crossovers. And right now, the Williams percent R, for those of you that may not use it, it's a medium stochastics. It's a great indicator of where institutional money is going. It's better than watching level 2 trading. It's better than slow, medium, or fast stochastics. It's better than on-balance volume. If you want to see where institutional money is going, a Williams percent R is ideal to see when big money is coming back in. The Dow Jones is still bearish. We're in no position to go all in and think our market, just because we've had a pretty standard 10% drop. S&P was down 9.83%. It's a pretty decent pullback. A correction is, you know, what, 10 to 20, and a bear market's 20% or more. Didn't quite get to it, but we were close. If we take a look at the S&P, just broke above the 200. Chart looks identical. No crossovers, no crossovers. We're still bearish with 1 day above the 200 day, but bigger money is coming in. So we're looking at it thinking, okay, we're close. We want to add shares. And I mean, the worst thing that can happen, we add those shares on Bank of America and we've got to add puts on them again. Not a big deal, but we'll do what we can. And then especially on the NASDAQ, oh, awful, right? Still bearish. Still have to get to 14,728 to hit the 200 day. Still bearish. Haven't broken over the median line on the Williams percent R. I think we're still in for a wild ride. I think we're still in to pay attention to, hey, things aren't going exactly like they had planned. I don't know. But if I was to take a guess right now today, I'd say February, we're probably going to be down 3%. And all I'm looking at is saying we're probably going to be in the range, at least have to test it, of 45. I'm not saying 45.15 to the 200 day at 44.38. We've got basically a 75-point range in there that we need to set a bottom. This is not a bottom. It's not building a base. This was not building a base, but we shot up. Just things to pay attention to see where we may end up. But the Chicago PMI today, pretty darn good. Out of Chicago, a 65.2 versus a 62.5. We still are showing growth in the Chicago area, the Philly Fed, basically everywhere but the Empire, New York, manufacturing numbers look up and look positive. Tomorrow we have the ISM manufacturing, expecting to come in at 75.5, with construction spending supposed to be up at 0.6. I would think both of those would beat. Construction spending will beat because of the new building permits was higher than expected. And I would say ISM manufacturing is going to be higher because the 6 or the 5 different areas where they do, the Philly Fed, the Chicago PMI, those kind of things, they all show growth except for New York. ADP employment. Well, are people getting back to work? The number's 220. The briefing number came in at 185. So there's a 35,000 person difference there. It'll be really interesting to see if we're getting back to employment numbers as people are just picking up new jobs to start the year. Let's face it, the ADP number comes nowhere close to the non-farm payroll or private payrolls. The new way they're doing the ADP has actually made it more difficult to predict our non-farm payrolls and private payrolls than make it easier. So pretty interesting altogether. Interesting comment from Cy. Kevin, with what you just told us, does it change your course? Hopefully I'm answering that right now, but if we do really start to fall, the one difference for protective puts is, yes, we can add 2 or 3, but we might as well add a short call on there too. We might as well try to take some credit in on the way down and have that add to what we're able to make up on the way down. This week is a heads up, and I'm just going to kind of stick it in here for today. China New Year week starts. And the China New Year's is actually tomorrow. But for a week, basically, China shuts down. So this week, don't expect a lot out of China. You probably will see their market stop for tomorrow and the rest of the week. And it's just not moving. So keep that in mind. All right, where am I going? For looking to trade, still going to add long put protection. You have no hope here. I really enjoyed Kramer beating up on SPACs. I thought it was kind of funny because earlier last year, they were the next best thing. I have an interesting article on the ARC Holdings that I showed you. More importantly, this was offered to me by someone in our group here. U.S. stocks have a terrible January. History offers plenty of I'm going to call it compassion, but it's comfort. We almost went through the worst January in history. There is a time where we're going to be down over 9%, where our 10% correction all came in a month, and we almost went through the worst January in history. If it wasn't for today and yesterday, it would have been it. Would have been it. So pretty interesting to see that the worst January in history was almost this month, except for the last 2 days. And this article came from Barron's, just as a heads up. But all they're doing is just saying, hey, there's history on our side. The problem with history, I'm pretty sure this history didn't have COVID. It didn't have a pandemic. It didn't have the type of administration that seems to be hurting business growth. It's funny because a lot of these things are similar, but a lot of them are different. As you've always heard, past history never guarantees future results. I have a couple other things I was going to show you. Adidas versus Nike versus Under Armour, stocks compared for 2020. Basically, they're saying Under Armour has the most upside. I will copy and paste this. And for those of you that are new here, if you head to www.myhurleyinvestment, I've got years of these recordings out there. www.myhurleyinvestment. It's singular there. In fact, I should just go ahead and bring it up for you. www.myhurleyinvestment.com. And we have years of recordings here on what we see in the market, what we're doing. This one was actually really good. We got a bunch that are really good. Don't hesitate to go through. You can scroll through the most recent ones right in here. But you want to figure out what we're invested in, why core holdings are listed here on the 10th of January. We work our numbers on core holdings. Same thing with new opportunities. Those are two good ones. Really, some great information here that I think will help you guys out. Robinhood loses active users in the fourth quarter, forecasts a weak guidance. I really would love to see these guys go out of business. They're crooked. We've been making the call. If you want something to just put puts on and ride the way down, these are the guys to do it. But what an awful job they did on their earnings. Love to see them below their IPO, and I can't wait to see them go out of business. They deserve it. And last but not least, I found a very interesting article on the big swings in the market are more than normal than investors might expect, but things could get worse. This is just the general, just like you saw in the big news, a general idea of some things that you can be looking forward to that'll give you guys red flags to say, you know what? probably not going to be an earnings season time, but probably going to have to pay attention to the averages and get that protection back on, if not double up for your way down. So there's some things that I'm going to suggest that you read, that I agree with their comments, that really give you some great ideas on what flags you can be looking for that will give you a heads up. In all honesty, in March, when we go through our Fed FOMC rate meeting, we're going to have everything will have protective puts on. It may be an intraday drop. It may be an overnight drop. It may bounce back in the same day. But to put it politely, people are idiots. You'll have a great opportunity when the first interest rate hike goes in to see the market just do a 5% one-day freak out or washout. Smart money is going to buy back in the next day, so be prepared. Or we're going to have everything protective put. We might even have everything fully collared just for the expectation on the drop down. But do understand the March interest rate hike, you've got to be prepared for a news event that could drive the market down 5 to 7 to possibly as much as 10%. So with that said, what questions do you guys have that I can answer for you? And Jerry, you asked a question about the drawdown on a protected put or collar position. It all depends. The short answer is, if you've got just a protective put on, you can see as much as what, a 5.5% drawdown. If you're seeing that much though, you should definitely see the ability to add another 10% more shares of stock. But what questions do you guys have that I can answer for you before I put all this together? Get it posted some here tomorrow, tonight or tomorrow morning. Interesting question. So yes, let me change this. Laggage are about 10%, and we have 3.5 million to still bring over. And as I can say for both of you, yes, Keeve and I have the same positions you guys are in. Absolutely. We're in it, we trade it, and off we go. A good question. Howard just asked, isn't the interest rate increase in March already priced in the market? If you were to ask me, I would say yes. But Howard, that's why I'm telling you, we're still going to have a 5% drop. It is priced in, but to make it as nice as possible, or to say it as simply as possible, Howard, when it comes to the stock market, I've noticed people just lose their shit. It's unbelievable how people just freak out. And I know that wasn't the most polite way to say it, but people lose their you-know-what. And in doing so, I think we've had an overreaction this year. I don't think people are working their numbers. I think the big push is a scare factor. So even though I think it's priced in, it would not surprise me to see a one-day drop of 4 or 5% and see it coming right back the next day. That's what I meant by it should be short-lived. But I'll be honest with you, I wouldn't try to outguess anything right now. If you're trying to outguess and want to run through the March expected interest rate hike without protection, I would really suggest against it. Whether it's baked in or not, people lose their crap. Any other questions? I like that one though. Isn't the interest rate hike already baked in? And this was from Howard. So the short answer, of course, is yes, but people still lose there. And I'll just kind of go like that. And then some, right? All right, well, hey guys, good to see some new people here. Love to have you. On Thursday, we have Keith taking care of our trade findings and adjustments. So Howard, Jerry, boy, Cy, you're new here. Dan, glad to have you. It looks like we have another Howard. Please make sure that you guys jump on in Thursday morning, 10 a.m. Mountain Standard Time. Dan, we hope to see you there. But it's just going to give us an opportunity to, again, show you what we're doing throughout the week and show you guys what we're looking to do. And yes, Jerry, let me just get that off to you. There you go, Jerry. Go ahead and copy that down. And tomorrow I run off on a plane, and the last 2 hours the market's open. Keith's gonna be covering, so I am Mountain Standard Time. Don't hesitate to give me a call. Maybe tomorrow evening. I land in Houston around 4 o'clock Central Standard Time. And if I can, Cy, can I quote you? So another thing of what we do, and Cy, thank you so much for saying it. Quote unquote, I lost my shit earlier and Keith pulled me off the cliff. That's what we're here for. That's what we're trying to do. Guys, have a great evening. I appreciate you being here. We look forward to seeing you Thursday. And Keith, I'll try to be on to watch, and we'll go through Thursday to see what we're looking at, what positions we're playing, what new option strategies are available. Really, Thursday is more of our trading that you might see in a live trading chat room. We'll go through some opportunities we see, or we'll go through some opportunities on why we don't see anything and why we're going to hold off on something. But I do hope this was helpful for you guys. Have a great evening, and I will talk to you again soon. Bye-bye.